Hey, stop scrolling. Today we're breaking down a high-stakes valuation gamble that has Wall Street completely divided. Ondas Holdings, ONDS. Its core enterprise value is a staggering $1.86 billion, which is nearly 17 times next year's projected revenue. The market is pricing ONDs like a top-tier software company, betting it will hit that ambitious $110 million revenue target by 2026. Is this real growth or a century trap where the stock is about to crash? Today, we're cutting straight to the chase. I'll use the most rigorous EV valuation method to expose the true pressure hidden behind ONDS's $7.18 stock price. And I'll give you the most actionable buy and sell points. Hit like and subscribe. We start in 5 seconds. All right, first, why is ONDS getting so much attention? Because of its growth. Revenue soared by 580%. This came from their autonomous systems sold to defense and infrastructure sectors, proving real market demand. On the conference call, management showed extreme confidence. They stressed that the record order backlog would support their drive toward the $110 million revenue target by 2026. And they stated that the $840 million in cash is there to ensure this goal is met on time. But pay close attention. To chase this target, operating expenses, OpEx, surged by 108%. This company is burning cash to pursue a very high goal. This is the core risk we must watch out for. Here's the core. We use the most relevant metric, EV forward revenue, to examine its intrinsic value. Approximately $1.86 billion. This figure represents the net cost of the core business after backing out the $840 million in cash. EV divided by the 2026 forecast revenue of $110 million results in a multiple of 16.91 times. The average multiple for the traditional defense industry is around 3.5 times. ONDS is priced at 5 times higher, but this is because it is betting on a high-margin IIoT software transition and high-barrier defense contracts. Top-tier industrial IoT software companies like Samsara are typically valued around 15 times. ONDS's current 16.91x multiple is higher than that of recognized top-tier industry peers. This is a bet that the company must not only succeed, but execute better than the best. The market's demands on ONDS are extremely high. There is zero room for error. Now let's look at risk and strategy. The biggest risk is not revenue. It's Q4 OpEx being out of control. If OpEx surges beyond expectations, it will significantly inflate the net loss. If the market loses confidence in OpEx efficiency, the 16.91x high valuation will face massive correction pressure. When dealing with high valuation stocks, we must identify technical and trading boundaries. Technical resistance level, $8.315. This is the key hurdle for bulls to sustain the rally and challenge higher peaks. Fair growth price, value anchor. Our 15x valuation anchor is around $6.61. Extreme technical buy point and stop loss line, $4.95. If the stock rapidly drops here due to OpEx news, this will be the absolute best short-term buying point. But note this, if $4.95 is broken, you must strictly execute your stop loss as it signals a complete trend collapse. To summarize, ONDS is an extreme game revolving around the 17x ultra-high valuation. If you truly believe in its execution, this is an opportunity. But if you are a conservative investor, I recommend waiting for the Q4 OpEx risk to clear and referring to our discussed fair value and technical buy points before considering an entry. I'm Alex. What's your decision? Let me know in the comments. See you next time. Bye.